right, let's just dive right into this explainer. Today, we're pulling back the curtain on something we all use literally every single day, yet most of us barely understand it. I'm talking about money, or more specifically, the highly secretive, unelected institutions that hold, well, absolute power over the global economy and your personal wallet. Now, you might not vote for the people running them, but believe me, their daily decisions completely dictate whether you can afford to buy a house, exactly how much your groceries are going to cost next month, and honestly, even if your job is secure. Let's start off with a pretty mind-blowing reality here. A single phrase from a central banker can wipe out billions of dollars in an absolute instant. I mean, it can crash the stock market, and it can literally make your rent go up. Big companies, commercial banks, global investors, they obsessively analyze every single word, every pause, every breath these officials take, desperately trying to guess their next move. Because here's the thing, the global market doesn't just react to what central banks actually do, it reacts violently to what it simply thinks they might do next. So to really wrap our heads around this immense power, it helps to think of the central bank as the big boss of all banks. We all know regular commercial banks, right? Places like Bank of America or HSBC, where we open savings accounts, grab credit cards, hit the ATM. But central banks, institutions like the US Federal Reserve, the European Central Bank, or the Reserve Bank of India, they don't have ATMs for you and me. Nope. They work entirely behind the scenes. They basically act as the bank for the commercial banks, securely controlling the entire foundational flow of money through the system. Now think of their first major tool, interest rates, kind of like the pedals in a car. When the economy is running way too hot and prices are just climbing too fast, the central bank hits the brake by raising the base interest rate. Suddenly, borrowing money for a car, a house, or running a small business becomes way more expensive, which effectively puts a huge damper on overall spending. On the flip side, if the economy is crashing and people are losing jobs, well, they hit the gas. They drop those rates, making borrowing super cheap again, which encourages a massive spending rally to get the economy back up to speed. To see the crazy power of just a single word in action, let's look at June 2021. U.S. Federal Reserve Chair Jerome Powell publicly called rising inflation transitory, basically meaning he thought it was just a temporary blip. So markets stayed perfectly calm, assuming the Fed wouldn't hit the brakes. But fast forward just a few months to November 2021, and he completely shifts his language. He admits, actually, it's not transitory at all. Boom! Markets instantly panicked and dropped fast. Investors realized rate hikes, basically slamming a much heavier foot on the brake, were coming way sooner than they thought, and they just rushed out to sell. But here's the catch. Central bank talk doesn't just stay neatly inside its own borders. It triggers this massive global ripple effect. For example, when the US raises rates, it means US government bonds suddenly pay higher interest. Foreign investors absolutely love this, so they scramble to buy up US bonds. But wait, to do that, they have to buy US dollars first, right? This sudden, massive demand makes the dollar incredibly strong. And hey, while a strong dollar might sound awesome for American tourists abroad, it actually causes massive global debt stress. It makes it unbelievably hard for developing countries to pay back their own debts that happen to be denominated in US dollars. All right, moving on to their second major tool, creating money. We've got to shatter a really common illusion right now. When you hear on the news that central banks are printing money, they almost never mean printing actual physical cash. In fact, a staggering 92% of the world's money is totally digital. It literally exists just as abstract numbers on a computer screen. So if they aren't firing up massive printing presses in a warehouse somewhere, how exactly are they increasing the money supply to keep the economy moving? Well, they do it through this incredibly powerful mechanism called an open market operation. When the economy is looking weak, central banks pull off this strategy by literally typing new digital numbers into existence. Just really think about that for a second. They just type it. They then use this brand new, out of thin air, digital money to buy government bonds from commercial banks. And in exchange for those bonds, they flood the commercial banks with something called reserves. It's basically a highly restricted, special type of VIP money that only banks can use to settle accounts with each other. But here's where it gets absolutely fascinating. Commercial banks do not take those central bank reserves and hand them out as loans to you and me. Instead, under our modern fractional reserve system, having more reserves just makes commercial banks feel safer to lend. So when you go get a loan for a car or a house, the bank just types new numbers into your loan account. They are essentially creating new money from absolutely nothing. I know, it sounds like magic, but this newly conjured money fuels real-world spending and, yeah, eventually inflation. Now, what happens when there's a massive crisis? Think the 2008 financial crash or a global pandemic. Regular open market operations just aren't enough to stop the bleeding. That's when central banks pull out the heavy-duty stuff, quantitative easing, or QE. You can think of QE as basically an extreme, massive scale version of creating money and buying bonds. It's specifically designed to inject a huge, overwhelming amount of money into the financial system incredibly fast. This dramatically lowers long-term interest rates, which strongly encourages people and businesses to get out there, borrow, and spend. But as you might guess, this incredibly powerful tool is highly controversial because QE injects so much money right at the very top of the financial system, it pushes big investors to desperately search for returns. They start buying up investment assets like stocks and real estate. Critics strongly argue that this artificial surge in demand fuels housing and stock inflation. In real-world terms, they say it simply makes those who already own assets significantly richer, while completely pricing everyday working-class people out of the housing market. Beyond tweaking interest rates and conjuring money, their third official tool is acting as a watchdog and the lender of last resort. Central banks are supposed to keep a really close eye on commercial banks so they don't take wild, dangerous risks. But if panic does strike, the central bank is the one who steps in with emergency money to stop a spreading contagion. This is exactly what the U.S. Federal Reserve did during the sudden 2023 Silicon Valley Bank collapse. They aggressively stepped in to guarantee deposits so terrified businesses wouldn't rush to withdraw all their cash and trigger a massive bank run. But let's be real, these central banks are absolutely not perfect. Sometimes they actually create the very disasters they're supposed to prevent. Take the lead up to the 2008 financial crisis. After 9/11 and the dot-com crash, the Fed kept the gas pedal pressed down with historic 1% interest rates for way too long. This easy money triggered a massive, reckless borrowing boom. Banks carelessly handed out mortgages to practically anyone with a pulse, creating an enormous housing bubble. And when that bubble finally popped, it triggered the catastrophic collapse of financial giants like Lehman Brothers and plunged us into a brutal global recession. It's also crucial to realize that textbook math can just completely fail when it collides with human reality. Just look at Japan's massive miscalculation. After Japan's own asset bubble popped in 1991, their central bank followed the economic textbook to the letter. They kept rates near zero for over 20 years to encourage borrowing and restart the economy. They even dropped rates to a negative 0.1%. But here's the kicker. Traumatized Japanese citizens flatly refused to take on debt. They stubbornly hoarded their savings instead. The gas pedal was pushed all the way to the floorboard, but the car absolutely refused to move. Because that textbook strategy utterly failed against human psychology and an aging population, honestly. Japan's economy stagnated for decades. To keep trying to fix it, Japan's central bank bought so many government bonds that they now own a massive chunk of their own country's debt. Today, this has pushed the Japanese government's debt to GDP ratio over a staggering 200%. It's a really harsh, glaring reminder that when central banks get the math wrong, the economic consequences don't just last a few years, they span across multiple generations. All right, peeling back the final layer of the onion here, we've got to look at who actually runs this boss of all banks. Why is there so much inherent suspicion around them? Well, it honestly starts with their historically factual but highly secretive origins. Following a really devastating bank panic in 1907, the U.S. government realized it desperately needed a backstop. So, in 1910, a small group of elite government officials and powerful Wall Street bankers met in total, absolute secrecy at a private resort on Jekyll Island, Georgia. That very meeting birthed the blueprint for what formally became the U.S. Federal Reserve in 1913. If we zoom out globally, the ownership and independence of central banks actually varies wildly. Most are officially public institutions, intentionally designed to be fully independent of day-to-day political pressure. In China, though, the central bank is fully government-controlled, with no independence at all. But then you have this wild surprise. In countries like Belgium, Japan, Greece, and Switzerland, central banks actually have publicly traded shares. You can literally log onto a brokerage account right now, buy stock in them, and collect a dividend. Though it's worth noting, that comes with absolutely zero voting power over their actual economic decisions. The United States, however, operates on this highly confusing public-private mix. It was historically designed this way to carefully balance power between Washington politicians and local bankers, but today it honestly just confuses people. The main headquarters, the Board of Governors, is based in Washington, D.C., and its powerful leaders are appointed by the U.S. President and confirmed by the Senate. So that top layer is completely public. But they also oversee 12 distinct regional branch banks spread entirely across the country, representing different economic districts. And here is where the controversy and endless suspicion really stem from.
These 12 regional Fed branches are partly owned by the very private commercial banks operating in their area. Legally, commercial banks are required to buy shares in their local Fed branch. In return, they receive a small, fixed dividend. Now, officially, these private banks have no control over major economic decisions, like where interest rates go. But you can see how this strange setup, where private banks literally own shares in the massive institution regulating them, fuels a tremendous amount of the conspiracy theories you see online today. Ultimately, these unelected officials wield a staggering, almost unimaginable amount of influence over our daily lives. With just a few keystrokes or a slight change in the interest rate pedal, they can single-handedly dictate the cost of your groceries, the long-term interest on your mortgage, your job security, and the overall health of the entire global economy. Understanding how they work isn't just a fun lesson in economics, it's basic financial self-defense. And it leaves us with one profound question that you really need to answer for yourself as you watch the markets move. Who really controls your financial future?